Hi there, welcome to Kneppy Invest and welcome to another answer and reply video. It is Saturday, the 7th of September, 10:13 a.m. I want to get through as many questions and reply or comments as possible in this video. So let's get stuck into it. And the first question is about franking credits from Astronomic YT. Now, this is going to be fairly easy for me. But let's go through the question first. Would you focus more on stocks, ETFs with franking credits, or would you focus more on high yield with no franking credits? And there's another question here. Would your current tax brackets matter in your own decision to buy franked or unfranked? But if you're in that position right now, not asking for personal advice. Now, the reason this is a really easy answer for me is because I don't focus on dividends at all. Hence, I don't really focus on whether or not a company has franking credits. In fact, the dividend status of a company is the last thing I look at. Another way I look at it is dividends are just a nice little added benefit of having or owning a company. I am looking for capital growth. And I actually sometimes prefer companies I own not to give their shareholders dividend. Focus more on the growth, because if they focus more on the growth, instead of giving dividends back to shareholders, they are able to grow at a better rate, a higher rate. And that is my preference for companies I own. Now, if this is just a hypothetical, if, me getting older is not a hypothetical, we all are getting older. But as I do get older, there is potential that my thoughts on this matter might change and dividends and franking credits would become more important. And in regards to your question, I have no idea what I'd be looking for here. High yield with no franking credits, I'm not even sure. There could be some mathematics behind this. Maybe some financial advisor could help you understand this question a little bit more, particularly the second bit. Would your current tax brackets matter in your own decision to buy franked or unfranked? But for me right now, this is completely unimportant. I don't focus on franking credits at all. If a company has them or not, doesn't matter to me one iota. But thank you for the question, Astronomic. Now, just because it doesn't matter to me, doesn't mean it shouldn't matter to you. We're all individual. And if you do have questions about franking credits, make sure you see someone who knows all about this area. And I am not that sort of person. Okay, Dong Gien. I'm assuming you're Vietnamese. So that's sort of like a Vietnamese name. Isn't that the most common Vietnamese name? Or one of the most common names or surnames in the world? Gien. Let me just Google that. I'm now interested. I'm a little bit curious. Sometimes you might see this. The most common surname of the Vietnamese people, how do you pronounce it? Gien? Goyen? How is Gien pronounced? When? Why is pronounced when? Okay, there you go. This shows you how ignorant I am. The correct Vietnamese starts with the sound n, as in singer, then translate mien. Okay, so that shows you how, I suppose, ignorant I am when it comes to different cultures. I couldn't even pronounce this surname, but yeah, for some reason I just knew it was the most common surname in Vietnam. So hopefully we've all learned something now, if you didn't know that. And this particular gentleman or lady, who knows, I have no idea, or maybe something else, who knows these days. Hi, Kneppy, what do you think of Cynata Therapeutics, CYP? Its products look quite interesting and broad in terms of applications to different diseases. It has Fujifilm involved in one of the products and also is a major shareholder. I could almost guarantee you know more about this company than I do. Now, in saying that, I first discovered this company back when it IPO'd, 2014 or 15, and there was actually a fair bit of excitement back in 2014, or maybe it was even 2015, around this company. And then that excitement died away. And I'm not even sure if this company, one little problem, ComSec is down for now. So let's have a look. So we don't need ComSec, but I do like the platform. I'm not even sure if Cynata has any revenue or any cash flow. So it's still in the development stage or the trial stage, that sort of thing. That's what I'm assuming right now. But again, you probably know this company a little bit more than I do. Now, I have become a lot more risk averse over the past few years. This might have been the sort of company that I would have had a closer look at 10 years ago. And that's probably why I discovered this company. So if we have a look at the most recent I'm just going to go back to their most recent Appendix 4C. I just want to see if they do have any cash flow. And clinical stage, that's what it's called, where they are still in the trial stage. So clinical stage biotechnology company. So straight away, this company is not yet producing any money. Phase 2 clinical trial. They're talking about phase 3 clinical trial in osteoarthritis, recruitment complete, patient follow-up ongoing. I do like when companies are at the phase 3 because if they do have success at the phase 3 trial stage, that can be a really exciting point for a company. And that is when I might become a little bit more excited about this company, but they have to get to that point first. And again, just going to confirm they have no cash receipts. Yeah, no cash receipts. So at this point in time, I would classify this company as a story stock. So they are building up a story. They have a story. They're marketing that story. And there's a lot that has to go right for this company to prove their story or turn their story into a business. So a lot of things have to go right. And maybe some of those things are out of the control of the company. So this, I think, these sort of companies, it all depends on how much you know the company. And I don't know this company all that well, how much you know the company and how or what is your risk profile? Are you willing to take a risk? Another thing you could do is you could buy a basket of these type of companies, particularly if you like, maybe 5 or 6 of these sort of companies, and just have a basket. And there is a possibility that one of those companies will hit pay dirt, and maybe the other 5 won't. But if one does, then you probably had significant returns. In my opinion, this is just my opinion, I have seen quite a few people absolutely burnt doing this, putting all your money into the one company. That is one thing, even though I can't advise you, that is one thing I personally would never do. I would never put all my eggs in the one basket, particularly when it comes to these type of companies, because you could lose all your money or you could become a multi-millionaire. So again, I think it all depends on your risk profile. For me personally, I'm not at that point. I need to see proof of model, proof of whatever. So I'm not there yet with Cynata. The last thing I just want to show you is the chart. CYP. I'm just going to confirm this company did list back in 2014-15. I'm pretty sure. My memory's not that bad. Yeah, 2013 maybe. Yeah, late 2013. Yeah, and yeah, I remember there was a lot of excitement in this company. So this was back in 2015. For some reason, yeah, there was one week where the share price of this company rose 125.64%, and then the next week it rose about 42%. And you can just see what happens. This is a classical scenario. A lot of interest in a company, share price rises rapidly, and then over the next or following year or so, the share price falls back to where it began. This is a case where greed is much more powerful than fear. And you might have heard me say time and time again that fear is much more powerful than greed. But a lot of times it's the complete opposite. And this is one of those occasions. And you'll see a lot of charts like this, particularly in smaller cap companies, particularly in mine exploring companies, clinical stage biotechnical companies, where they might just release one really interesting, significant announcement, the share price and the market gets really excited for a very short period of time. But a lot of times that excitement dies away fairly quickly. And that is probably one of my biggest problems around these companies. And you see this company has been quite volatile. Share price went as high as almost $2 back in 2019 and now is about 20 cents. I'm not there yet with this company. Yet. Another thing, I'd just have a look at the chart. Is the market excited about this company just now? Share price has fallen a fair bit over the past few months, so keep that in the back of your mind as well. What's the market cap, by the way? What is the market? $34 million. So thank you for that question, Dung. Next question is from Jake Su. Great video as always. You got me interested in ASX and weather as well. Haha, just watched the Twisters. Good, quite good. Tornado chaser in Oklahoma. Yes, yes. Reminds me when you talk about you go the chase storm, if I remember correctly. I've been storm chasing in the past. I have seen tornadoes. I lived in Oklahoma for about 4 years. I went to graduate school at the University of Oklahoma. That is the epicenter of some of the best meteorological research laboratories in the world, not only in the United States, but also the world, particularly when it comes to storms and severe storms. I once drove a Doppler on wheels, which is a radar on wheels from Oklahoma all the way to Juneau, Alaska, and then all the way back. Yep. And also from Juneau to Boise and then back again. So a lot of interest in people because it looks like a UFO on the back of a truck. So great memories of my time then. That was back in the early 2000s. And yeah, some of my fondest times are going storm chasing. But one of the problems back then, even then, were the amount of, I'd say, non-professionals going storm chasing. And I believe it's even worse. Now, the first Twister movie, way over the top. They got a lot of the science wrong. Even this latest Twisters movie, much better when it comes to science, but still, yeah, as an expert in this field, you do see little errors they make when it comes to the science. But that's okay. For the general public, they don't understand that. And it was a good movie. Actually, I didn't mind Twisters. In fact, maybe this could be controversial. I probably prefer the Twisters over the original Twister with was it Helen Hunt and Bill Paxton with a Philip Seymour Hoffman in a supporting role. Thank you for that, Jack Sue. Thank you for taking me down memory lane. Stocks under the hood. Thanks for covering my comment. I remained Sidev and Pantoro bull. Latest buy was a position in Maida on Friday on a bullish uptick, potentially in lieu of a good result. Fingers crossed. We can have a look. Did I like that one? Yes. We can have a look. I'm going to have a look at all these charts. So I've come to the realization, I think, that I probably shouldn't say the companies I own. I want to be as unbiased as possible, and saying what companies I own, what companies I've bought, what companies I sold could be considered a way of influencing you to buy or sell same company. So from now on, I will not say whether I hold a company or not. And I'm trying to be as unbiased as possible. So let's have a look at all these three charts. SciDev, Pantoro, and Maida Group. We'll start with SciDev because that was the first one listed. This is a company, I'd always call this company a water solutions company. If you have a look at the weekly chart, this share price of this company is all over the place. A lot of excitement back in 2019 for SciDev. And that is the point where the revenue of this company started to really grow. Beautiful growth in cash receipts, if you have a look at the Appendix 4C history. And then the share price took a bit of a dive back in late 2021, early 2022, because that's when interest rates started to rise. And the cash flow status of this company came under a little bit of threat. But again, just have a look at the chart, daily chart of this company recently. Share price has broken or did break out back in April. That was on the back of their Appendix 4C, and the share price has continued to climb since then. So pretty nice looking chart for SciDev. And this is the definition of an uptrend. Higher highs, higher lows. Hopefully that is fairly obvious. Another thing I look for is volume. Now, the problem with SciDev is you have these spikes of volume, which could be a fund manager. Don't know. But what I really want to see is an increasing volume. And you see subtle signs of an increase in volume, but not absolutely apparent. Pantoro is another nice looking chart. This one, again, a downtrend. How long was this downtrend for? Share price moved into downtrend back in June 2022 at a share price of about 28 cents. And we saw it turn back up probably in April of this year. So about 2-year downtrend, and the share price, when it started to turn, was about 6 cents. So beautiful downtrend. And now Pantoro has moved into an uptrend. A little bit of a more steady uptrend than SciDev. And I do like these sort of uptrends that are nice, orderly uptrends. A little bit of a dip back in July. That was a nice little buy the dip situation. And nothing to complain about this chart. Again, volume, I would probably prefer to see a little bit more volume. But if you do look at the volume from March through to now and just compare it when the share price was in a downtrend, you can definitely see an increase in volume. So there is an increase in interest in this company since the share price started to move in uptrend. And that's actually a pretty good sign. Maida Group, did they have a good results? I have a feeling the share price fell, didn't it? Yeah. I have a feeling the share price fell. I'm just going to have a very quick look. Quick look at FinChat. We'll look at Meta Group. And I'm just going to have a very quick look at their financials. I'm pretty sure this company is growing at a really nice rate. Hasn't been long on the ASX. Does it mention here when it listed? It says year found. I like this, but it doesn't say when it listed. So founded in 2005, but it doesn't say when it's listed. I would assume it listed by this chart here on the right-hand side in October 2019. Now, we can confirm this via Market Index. If you go to the website or the page for Meta and go to the announcement page, go all the way to the very first announcement, and there we have it. Meta Group, prospectus, everything released on the 30th of September 2019. So they probably listed the next day. Yeah, that's what I'm assuming at this point in time. I know. So because they've only been listed for 5 years, we don't have all the information. So we don't have 10-year revenue growth, 10-year earnings per share growth. We do have 5 years because when a company does list, they also provide their financial statements. Here we go. They provide the financial statements for 2016, 2017. So we do have more than 5 years of financial history for this company. So let's go back to FinChat. And this company has grown quite impressively since they listed. In fact, if we just look at the last 5 years, revenue has grown at 27.6%. Pretty nice. Earnings per share over the same period up 22.15%. Pretty nice. Dividends, they haven't got a 5-year dividend growth, only 3 years, but that's it. Well, that makes sense because 5 years ago, this company was not yet listed. So they didn't have a dividend that year, but they did have revenue and they did have earnings per share because, well, maybe not earnings per share, because they wouldn't have any shares before they listed. Anyway, but dividends over the last 3 years have grown at 37.51% per year. Some of the other things I look at, let's have a look at the quality of this company. So I look at gross margins, 20.92%. Now, that's on the lower side, which is understandable because this company is more of a services company for the mining, energy, industrial sectors. So I would expect lower margins for those type of companies. So then I look at return on equity, 39.36%. It's over the last 5 years. That's an average. That's pretty nice. Return on invested capital, 22.82%. Return on capital employed, 41.88%. Now, the other thing you have to do is I always question these numbers. Because sometimes you do see it a little bit different depending which platform you look at. But if those numbers are real, this is sort of an indication of at least a quasi-high-quality company. They've done it pretty good over the last 5 years. In terms of valuation, P ratio 22.17, looks pretty nice. You do want, if this, in fact, that P ratio is below that of the CBA, in which one's growing at a much greater rate. This one. So Meta Group 22.17 is not that stretched when you look at other companies on the ASX. What else do we have here? We have a PEG ratio of 2.24. So the market's not expecting significant growth, I think, based off that. So earnings per share forward 2 years, 14.76%. Okay. Net debt, $39.5 million. So not that much net debt. But the market didn't like these results. So revenue change, nice growth in revenue, 27.2%. Income went up from 38 million to 50 million. I can't answer why the market didn't like it. It could be a number of things. It could be the results were a little bit weaker than expected, or maybe it's just the outlook. The chart for Meta Group is interesting. I will give you that. And maybe not interesting for the right reason, because if you go all the way back to when, maybe not when they listed, but because it really, share price of this company really didn't do anything, did it? So they listed just before COVID-19. Share price fell all the way down to 65 cents during COVID-19. And as it came out of COVID-19, we didn't see much of a V-shaped recovery. Share price sort of went sideways for a long period of time in 2021. Share price broke out. This is the definition of breakout. Beautiful definition of breakout around about August 2021. I would assume they released some pretty good results in August of 2021. Share price broke out then. You could have bought this company for about $1.15, and the share price remained in a beautiful uptrend. From there, share price started to go sideways. So the uptrend really started to come an end here. This would have been in August 2023, so 1 year ago. And I would actually say there is definitely an argument the share price is now in a downer trend. In fact, there is a crossover between the two moving averages, the 20-day and the 100-day. Wish it was 25 and 100, but you don't have that in trading view. So weaker than expected results or weaker than expected outlook, and the market is a little bit negative on this company right now. Not only that, volume really exploded. So assuming they release their results on the 20th of August. Let me just confirm that. Yep, 20th of August. And the share price did sell off. So a weak response from the market in return in regards to their results. So stocks under the hood was thinking the results were going to be good and the share price would lift. So we all make mistakes. And that's one thing we have to understand. We all make mistakes and we should never judge ourselves on one mistake. I think I told the story recently about an athlete. He was on a podcast. I forget who it was. And he said something really illuminating to me. He said, because he's retired now, he said when he would look back at a match after he played it, he could have done 20 things. He could have done everything right except one thing. Wrong thing he did, and that's the thing he would focus on. And he said that was not healthy because he would just be fixated on one thing he would do wrong. And I think it's good to understand where we've gone wrong, and because that's how we learn. But being fixated on that one thing you've done wrong or a few things you've done wrong, but also not acknowledging what you've done right. Why did you succeed? Why have you done well? If you don't acknowledge that, then I think it's probably not the best attitude to have. That's just me. I think you need well-rounded thoughts, thinking. Nice 007. Oh, nice 007 420. I wonder if Nice wants to be Bond. Great video. What do you think about Nike stock? No idea. I will tell you that right now. What about Nike shoes? Never wear them. I wear Brooks. That's my running shoes. The Nike movie was pretty good. I liked that movie. The Michael Jordan Nike movie. What was it called again? Get out of the way. I've got this. You probably can't see. There's a zoom little thing up here that's just in the way of all my tabs. It's actually really annoying. There it is. It's just gone away. Nike movie. What? I forget what it was called. Air. That was called Air. How can I forget that title? Yeah, it had Ben Affleck as Phil Knight. Fascinating movie. I really like that movie. It was a good movie. Rotten Tomatoes, 93%. There you go. 7.4% on IMDb, 73% on Metacritic. Yeah, enjoyed the movie. I never recommend movies because everyone's different. We all have different tastes. There are some movies I would never recommend, even though I think they're absolutely amazing movies, like Requiem for a Dream. I would never, ever recommend that movie to anyone, even though I do believe that movie should be shown in every single high school through the world. If we do that, we've solved the drug problems because no one would ever want to take drugs after watching that movie. But that's one movie I would never recommend. There's other movies I would never recommend because I think they're terrible. And one of the reasons I never recommend a movie is because just because I might like it, other people might hate it because everyone's different. I did like the Dune movies, though. I really like those. We're all different. Anyway, let's go back. Nike, because I went on a bit of a tangent then, didn't I? Okay, I know nothing. I've never looked at Nike. So let's do what I do when I first started researching a company. The first thing I do, are you going to work? So overview. I'm going to have a look at the chart in a second. I have a bad feeling the chart looks pretty weak. CEO is still, no, it's John J. Donohue. He founded in 1964. Market cap of the company is $121.2 billion. Say that again, $121.2 billion. That's a market cap of this shoe company. Do they sell anything else? Footwear, apparel, equipment. Okay. They also own Converse, Chuck Taylor, All Star, One Star, Star Chevron. Anyway. So let's just have a look at the returns Return on equity, 40.13. That's pretty nice. Return on invested capital, 26.96. Really nice quality metrics there. Gross margins, 44.68%. I'm assuming that's pretty good. The other thing I like to do is look at the history of gross margins. Are they rising? Are they dropping? I'll do that as well with this company, but I'm not going to do it right now. P/E ratio is 21.62. It might be low, might be high, might be low. I'd like to have a look at the history of the P/E ratio. Look at the growth. So revenue growth over the last 10 years, 6.33%. Seems low, doesn't it? If you look at the growth and revenue growth in this company over the last 3, 5, 10 years, it does look pretty low. Earnings per share growth, last 10 years, 9.61%. Looks like it's slowing as well. So the last 3 years, only 1.57%. Dividend growth, more than 10% per year. So the payout looks like it is increasing. So fairly minimal growth, but that might be expected for a company this size. So that P/E ratio might be a little bit elevated based off their growth or lack of growth, but really nice valuation or quality metrics, return equity, that sort of thing. What else? Yeah, that's what I'm going to talk about when it comes to Nike. I'd probably want to have a look at maybe their most recent presentation. They do have in FinChat, they do have a investor relations, and you can only look at their transcript. Sometimes they will have presentations in this, but not Nike. Filings, maybe you want to look at the most recent filings, annual report, quarterly report, those sort of things. I'd have a look at that. And the last thing I'd do, and I think the most important thing here is this a high quality company? I think there is definite arguments to say yes when it comes to quality metrics like return on equity, but the lack of growth, so the growth isn't maybe quite as high as I would like. That's probably my only red flag when it comes to this company, but that's my own red flag. That sort of growth may be okay for you because this is a pretty big, even you could even say this is almost mature company. So let's have a look at the chart for Nike. And the other thing is, if you do think this company is high quality, is the company good value right now? Now, the share price has fallen. Share price is in a downtrend. When they released the most recent quarter, share price fell a fair bit. So obviously the quality results disappointed the market. Would have also been the outlook. Share price on that day dropped 20%. Let's have a look at the weekly chart. A lot of times you can have a look at a weekly chart or just a monthly chart and you can see the telltale signs of a high quality company. In fact, if you exclude the last few years, this is a chart of a high quality company. In fact, you should almost log this chart. So where's the log? There it is. Yep, you logged it. This share price of this company has been in a beautiful uptrend since 1986. Share price back then was like 18 cents. Anyway, let's go back to the non-log. What do you call it? The non-log? We call that the normal chart. I don't know. And I would actually say the chart for Nike is looking the weakest it's ever been. Well, maybe not ever. Maybe back in 1983. Share price now is in downtrend. I really can't say that. Maybe the last time you could have said it was in a downtrend. I wouldn't have even said, no, it wasn't a downtrend back in the late 90s, early 2000s, because the share price was going sideways. It was consolidating. You can tell that by all these crossovers. And if you just keep on going back, yeah, maybe here, back in 1997, 98, you could have maybe said the share price was looking fairly weak and maybe in a downtrend. But in just hindsight, it was just going sideways. And I think right now it does look the weakest because both moving average channels are in the red. And I don't think you could have said that at any previous time. No. And that's telling maybe for a slight period back in 2001, but this is definitely looked the weakest for Nike. So just the lack of growth, or probably it's not really the lack of growth. It's I do prefer slightly higher growth. That's just me. But in saying that, if the share price of Nike falls a little bit lower and there's good value, maybe I'll take a position in this company. So this comes back to What are your thoughts about this company? High quality, not high quality. Is there good value in this company at current share prices? So that's something you have to answer yourself. Only you can answer that. Is this company good quality? Is this company good value right now? If it's not good quality, first question might be, why would you think about buying shares? But I do trade non-high quality companies, and I would not be trading this right now because the share price is in a well-defined downtrend. There's no argument against that right now. So thank you, Nice007 420. The other thing I don't know about Nike is a presentation can be really good because sometimes they will tell you what they're planning for the future, and that's fairly important for me when I am interested in a high quality company. And I might consider this high quality company, but I want to know, what are their plans for the future? Do they have 5-year goals? That sort of thing. Spawn of the Noobs, RLT, has had some performance recently. I'm pretty sure I talked about RLT last week. I'm pretty sure I did. Renogen. I've talked about that recently, so I'm going to skip by Renogen. Pretty sure I've talked about it. I could be mistaken. Jazz and Tails. Hi, Michael. Thanks for your informative info on your passion for the financial stock market of the world. Been watching vids since January this year. I'm really enjoying the channel and appreciate your time and efforts. I have a question about your screener for buy on the dip. Signal on TradingView. Can you please go through the setup for this again? My current setting only achieves 2 matches. So this is probably a screener that I don't use all that often. So it's a buy the dip. And I'll just show you. So I've got 20 matches now on the ASX. So we have Wesfarmers. Let's have a look at the chart for Wesfarmers. So it has pulled back the last 2 trading days. So is this a buy the dip situation for Wesfarmers? That's the whole thing about this particular screener. I have to ask myself, is this a buy the dip situation for Wesfarmers? And Sol Patterson, we have seen a little bit of a dip. It's just a small dip. Capricorn Metals, 1-day dip. I don't know if I call that a big dip. Magellan Financial, this is a much bigger dip. Oh, we're looking at dailies. We're looking at weeklies. I want to look at dailies. Okay. Yeah, okay, so this is better. So this has, share price of Wesfarmers has really pulled back the last 2 weeks. So again, is this a buy the dip situation? I think there's a lot of answers or questions you have to ask yourself when it comes to this. So quite a few companies, I think, fit this. Sol Patterson, share price has dipped. Probably less bullish about this one. Capricorn Metals, share price has dipped. Magellan, share price has dipped. Probably not as keen as this one either. We have other ones here. Atomos, I'm not content. So those are 4 main ones. Wesfarmers, Sol Patterson, Capricorn Metals, Magellan. Are these buy the dip situations? And I'll just tell you what I have in how I've set this screener up. So we've got relative strength index 14 below value of 40. I tinkered with that for a while. And also exponential moving average 20 above the exponential moving average 50. So those are the 2 main screeners within this. Would you call it screeners? What do you call these? Indicate, well, filters. Filters, that's the word. Those are my 2 main filters for this screener. And I have tinkered with that quite a few times. So I would actually recommend tinkering and tinkering and tinkering. But I will be honest, I don't use this screener as nearly as much as I use my other screeners. And my other screeners I use all the time. 20 and 100-day moving average cross. I wish it was 25 and 100. Also look at 3-month high, 6-month high, sort of combined. And the other screener I look at is, my favorite screener is probably unusual volume. So I'm looking at breakouts on higher than average volume. So that actually does work well. So hopefully I've helped you with that, Jazz and Tails. Daisuke says, Bitcoin is still one of the top performing assets in the world. Also, BlackRock's ETF fund recently hit 20 billion. Long-term Bitcoin is bullish AF, I believe. Well, I won't argue with you because I do have a little bit of money in Bitcoin. Not a lot, but just a little bit, because the whole reason I personally put a little bit of money in Bitcoin is, if I do have a bull case for Bitcoin, if the ultra bull case for Bitcoin. The ultra, I'm not sure what the likelihood of this is actually going to happen, is that Bitcoin becomes a reserve currency. And if that happens, all bets are off. That's like the bullish scenario. I think the likelihood of that happening is probably quite low. But if it does happen, Bitcoin will be significantly higher than it is now. And I think it's legit. If it wasn't legit, it's been around for 10 years now, over 10 years. And if it wasn't legit, we wouldn't be getting all these fund matters. I think it's legit. And it is a new type of asset. And I can definitely see cases for people all around the world using Bitcoin to maintain their value, their wealth, that sort of thing. Yeah. Ryu Kayan, hi Kneppy, I recently had an idea which I want to share with you about using MA 50 and 200 as a filter to find stocks that are crossing over. Well, this is a long one. Very innovative, I know. The idea is supply. Because this is really long, I'm going to move on to the next one, and I'll read this individually. Sorry, Raoul, because it's very long, and I might need a little bit of thinking when it comes to this one. Landy Lee says, what are your thoughts on Duratec? Okay, so Duratec. The company did release. Oh, there it is again. I think I can move this little thing across. I can. So let's do the same thing with Duratec as I've done with other companies. Let's have a look at the financial situation of this company, and then you can draw your own conclusions. So the overview of Duratec, I would say it's a sort of a mining service. It's not really a mining services company. I'm not sure what I'd define this company as. It's only a services company, but defense, mining, industrial, and buildings and facades segments, yeah. Markup $323 million. Founded 2010. Gross margins will be fairly low for this type of company. They are at 17.3%. The other thing I want to see is return on equity. Why is that not rising there? Why? Oh, that's right. For some reason, I had the Nike conference call there showing up. I would assume also, I'm going to see if, actually I was wrong. I was going to say I would assume that the quality metrics are quite low, but return equity is at 39.2%, return on invested capital at 14.3%. So it's probably a little bit higher than I would have expected. P ratio is 15.7. I thought that was a little bit lower. That's interesting. Some of the other valuation metrics do seem quite low. So there could be an argument, maybe this company is good value, but maybe there's a reason behind that. Maybe the market is fairly bearish about the outlook for this company. Maybe that's because they gave an outlook themselves. Valuation next 12 months, PE is at 13.1. So forward-looking PE looks pretty low. PEG is at 1.1. If they maintain their growth, company might be fair value. That's what the PEG ratio 1.1 suggesting. Very, very slightly overvalued, but that's about it. EV/EBITDA 5.48. Price to free cash flow 15.26. So that's a forward-looking. And yeah, not too stretched there. Debt. Oh, they're net cash, according to that. Revenue growth the last 5 years, 22.63%. I am assuming this company listed like 4 years ago. Am I wrong? 2020? Let me have a look. When did they list? 2020. Okay, I was right. Yeah, so this company has been around for about 4 years. So again, what they've done is they went back to Duratec's financial statements for 2020, 2019, 2018, and they've used those to get the 5-year revenue growth, which is 22.6%. We don't have a 5-year earnings per share growth. What else do we have here? A dividend yield of 3.1%, payout ratio 14.46. And I'd say there's pretty nice growth, just looking at the revenue growth. I mean, this is the first thing I look at. Usually it's just a revenue growth. Then I have a look at the margins, and they've changed. Finch had changed everything. It used to be, there it is, ratios. I have to learn how to do this now. There's the margin. Yeah, they've definitely changed this. Used to be across the screen, not down the screen. So one thing I'd look at for all companies is how are the gross margins going? So there was a little bit of dip in 2022. But the last 2 years, the gross margins have increased. That's actually a good sign moving forward. And then I'd look at free cash flow, operating cash flow, all those sort of things. Revenue is increasing, but shares on issue increasing. Is this company doing acquisitions? Is that how they're growing? That's another question. Another question would be management. What do you think about the management? I have no thoughts about this company's management. I do think there is probably an argument about valuation. This company could be good value, but that's up to you. I probably would not on the quality spectrum. I don't think I would call this company a high quality company. Probably not there yet. I think maybe a few more years if they can grow, maybe increase their margins, maintain high return on equity, return on invested capital. I could envisage myself saying this is a high quality company. So let's have a look at the chart for Duratec. Now I do have to get rid of some stuff, so you don't know that I'm holding or trading companies. So Duratec was a beautiful chart. There's me buying some shares way back, and that's far enough back that I don't mind sharing with you. So I did buy some shares on a breakout. It was a little bit after the breakout. Beautiful breakout. After they listed, share price went in a downtrend, and then definite signs of it turning around. Sentiment in the trend of share price turning around in the middle of 2022. And this is a beauty. Just study this chart. Just look at what happened. Look at the volume. Share price broke out. When did it break out? It broke out on the 7th of November 2022. There was a little bit of selling on that day. And then, yeah, the share price never fell below this dash line. So that's a good sign. So I bought 2 weeks after the breakout, 55.5 cents, and looked pretty good for about a year and a bit. Started to show weaknesses. The first sign of weaknesses was in September, October of 2023, and definitely a bit of weakness in March, April of this year. But it does look like maybe the share price wants to move back into an uptrend. And I don't think this company could be considered overvalued right now. So that's my thoughts on Duratec. Hopefully that's helped. Oh, you've got two there. Hopefully I helped you 2 times over. Sham G33. Audinate has been regular on the Hot Copper forum since the first prelim report. I wouldn't know. I very rarely go to Hot Copper. Sometimes I will go to Hot Copper just to see how much it is talked about. And if I see a lack of chatter on a company, I'll go, oh, that makes this company a little bit more exciting. If I see a lot of chatter on a company, that's a massive red flag for me. There's a reason behind that, because I do think a Hot Copper forum can be sort of a gauge of hype. Put it that way, hype, yeah. It can be definitely a gauge of hype, and I do prefer to stay out of hyped companies. Not all the time, but mostly I do. And Audinate. I have noticed a few people buying Audinate. And when I say a few people, I'm talking about people that I'm involved with. Not involved in that sort of way, but people that I not work with, but people I know. Investors I know, put it that way. They don't know who I am, but I know who. They don't know who I am because I have a different name, but I can follow what people are doing. And that's very important. Some private groups, put it that way, private groups. So Audinate. Let's have a look at the chart. I missed it. So when they released their results, share price opened at $6 or something like that, which if I knew the share price was going to open at $6, I should have put a bid in. I was like, I don't know why anyone would be selling this company at $6. That was ridiculous. Share price did really nice bounce, went from $6 back up to almost $12. Share price has pulled back a little bit since then, now about $9 or just above $9. And if we go back to FinChat, I don't know if you could say there's good value in this company just yet. This is a sort of company where I think you do have to have some sort of an opinion about the outlook of the company. Now, I have heard some people say this company has one of the best moats on the ASX, but I've also read some people say that moat is over-exaggerated. Who knows who's right? I've heard people say this company has a great moat, one of the best moats, more than the other. Anyway, let's have a look at some of their metrics. The market cap of this company has come down a lot, 778 million, P/E ratio 74.7, but there is potential for significant growth. You can just see that with the revenue growth over the last, we'll say 3 years. It's up 40%. Earnings per share, is this company profitable? I think they're just profitable. So it does have a earnings per share growth at 39.9%, but yeah, anyway. And you don't have valuation metrics quality metrics just yet, which probably means the company is not that profitable. Anyway, now the company did go through a little bit of a what would call it 2019, 2020, 2021, where revenue didn't grow all that much, and then it just exploded the last 3 or 4 years. In fact, it's almost tripled. And I wouldn't be surprised to see another maybe one not bad year, but where there's not much growth, and then a couple of really good years. And I don't think a company like this will necessarily grow in a straight line. There might be some weak years and then some really strong years, but definitely there is growth when it comes to this company. And let's have a look if I can find it. If I can find it, it just doesn't want to work for me. Gross margins. So yeah, one thing I would look at with this company is the gross margins. If you do see gross margins dropping, that can be a negative sign. One way I view gross margins, particularly if they're dropping or rising, it's a sort of an indication of the moat, of the competitive advantage of the company. If you do see gross margin dropping, that could be a sign that there is competition and they're eroding into the gross margin. But if you see gross margins rising, and it could be rising, or they could be showing competitive advantage or a moat just simply because of their brand. Maybe the Audinate name is really well known and really well liked, and so people are more willing to pay a premium for their products, that sort of thing. Like Coke, if you have Coke and Pepsi, people are more willing to pay a little bit more for Coke than Pepsi because of their brand. I actually prefer Pepsi over Coke, particularly Pepsi Max. In fact, I don't really like Coke, but the majority of people will prefer to pay a little bit of a premium for Coke because of the name. So that's a really good example of brand moat, brand competitive advantage. I would say that Coke could increase their prices by 40% and probably still sell a lot of product. So I think Audinate is a sort of company where it's all about the future. What do you think about the future of this company? Do you think the moat, the competitive advantage, is over-exaggerated, like some people do? Or do you think this is one of the best moats on the ASX? So I probably err towards the positive than the negative, but it can be beneficial to err towards the negative. Put a bit of a margin of safety. So if you see the share price of this company drop to say $3, maybe that's the time to buy. Okay, still waiting for Comsec to, nope, still out. Probably talked longer about Audinate than I could have. Stu Percy says Reece Plumbing founders own most of the shares. I was going to say owners own most of the shares, which owners own 100% of the shares because that's the name. Owners own the shares. But anyway, founders own most of the shares and has always been expensive. I've been waiting for years for the price to come down. So let's have a look at Reece Plumbing. Let's see if this is true. I'm not doubting. Maybe it's called Reece. I'm not doubting the assertions you have made, but we don't have to believe everything we read. That is the problem among a lot of people these days. They just see something or read something and automatically believe it. I have seen this time and time again. Oh, it drives me bonkers sometimes when I hear the absolute rubbish coming out of people's mouths. Well, I read it. I read it on Facebook. It must be true. I can definitely see why people easily manipulated. Just believe anything. Okay. In Reece, they do have an ownership here. So, Leslie Ann Wilson and John Gay Wilson combined own 11.69%. I'm assuming they're either married, brother or sister. I'm assuming Leslie Allen Wilson. That's not a, I was going to say that's a woman, but that's a man. So brothers. We also have Peter J. Wilson, David Allen Wilson. So there is a potential there could be father, brothers, uncles, fathers, sons. Combined, those four Wilson. Actually, there's another Wilson here. There's 5 Wilsons here because we have a Bruce Walter Campbell Wilson. So those 5 Wilsonsons, although the last few don't own many. So those combined own probably about 13 to 14% of the company. Okay, there you go. So there is a fair bit of insider ownership. Maybe there's not as much as founders own most of the shares. According to FinChat, that's not real. Now, we can actually verify that. Let's go to Market Index, because I'm pretty sure Market Index has the same sort of thing somewhere down here. I don't really look at it all that often. Dividend policy. Here we go. So you see all the Wilsons here. So according to that, according to this, the Wilsons own way more shares than what FinChat is showing. Another one I do look at sometimes is ticker. Do I have ticker here? Yes, I do. Ticker also has an ownership. I don't look at ticker as much as I used to, but they also have an ownership. And this one is a little bit different. So you can just see, I mentioned this before, sometimes the information on some of these platforms could be a little bit wrong. So according to ticker, LT Wilson owns 24.34% of the company, or 157 million shares. If we go back to Market Index, so they're all different. They're all different. And there could be some superannuations here. So maybe LT, so there's an LT Wilson Family Trust. So some of these might be the Wilsonsons super, and maybe that's what Market Index does. They just combine their super. And if that is so, they do own a majority of the shares, I think, according to this. And what's the other thing Stu Percy says? It has been expensive, always expensive. We can actually look at this. And here's the thing. If a P ratio of a company never is below 40, has never been below 40, and the P ratio right now is 42, would you consider that company to be expensive? I actually would say differently. I'd say, oh, this company is cheap. If you look at the history, or the P ratio now is below 40, it's at 39. This company has never been cheaper, even though the P ratio is 39. So it's all relative. So the best way to look at this is just to go to financials. Again, they've changed it. So I used to be really quick at doing this. And I think we have to go to ratios. And hopefully it's in the first one. Oh, it takes a while to change. This is getting annoying, FinChat. And there's a P ratio here. We can have a look at the historical P ratio of this company. So right now it's 40, but prior to 2020, the P ratio of Reece, and again, this is one platform, the P ratio of Reece was or traded between 20 and 30. It went to a high of 60 in 2021, 2022, fell all the way back to 20 in early 2023. That was a good time to buy based off valuation, and now is at 40. So I wouldn't consider this company yet right now to be cheap. Definitely not cheap. It's more towards the expensive side. So what you could do for a company like this is have a look at the PE ratio. What is the market willing to pay for this company? And for this one, say 20. And if you see the PE ratio get down to 20, you go, whoa, this is good value. So the PE ratio of this company got down to 20 back on the 3rd of January 2023. So let's have a look at the chart. And I can almost guarantee you the chart looked pretty ugly at that point. So January 2023, yep, share price was down to $14. And then there was a quick turnaround. Yeah, so that was a pretty good time to buy this company back then. Particularly between January and March of 2023, there was a turnaround in sentiment, turnaround the trend, the share price, and at a P ratio of 20, that was good buying for this company. All right, so that's all I got for Reece. Someone mentioned DGL, their revenue keeps growing, but their earnings are going down last 3 years at least. Isn't that a major red flag? Yes, it can be a major red flag. Let's have a look at DGL. But there could be cyclicality issues at play for DGL. In fact, let's have a look at the last 3 years of financials. In fact, let's have a look at the overview of the company first. This will be my last question of the day. So it's a chemical company. That's the best chemical and warehousing company and distribution. They call themselves chemical formulation, manufacturing, warehousing, and distribution. I just think chemical warehousing. Simon Henry is the CEO. Founded in 1984. Markup is only 136 million. P ratio, no. P ratio forward looking is 8.6. So if they do achieve what the market expects, this company would be considered cheap. Okay, so the growth in revenue over the last 3 years is 44.4%. Over the last 5 years is 48.55%. Pretty sure this company has been quite acquisitive. So there probably has been an increase on shares on issue. Return equity 13.96, return invested capital 6.9. So it's on the borderline of being close to a high quality company. But the company has experienced some problems the last few years with the business itself and also Simon Henry's loud mouth. Okay, so let's have a look at the financials. Have a look at the revenue. So according to this, now this is again revenue. I would love to see revenue per share. Guru Focus did have revenue per share. Unfortunately, I am not a subscriber of Guru Focus, and you do have free access, but let's have a look. Free access. Yep, you've reached the limits. I wonder, DGL, Guru Focus. I wonder if I can do this. This worked the other day with me. Yeah. No, I didn't. No. Because the reason I did like Guru Focus because they did have revenue per share instead of just revenue. They also had revenue, but I love revenue per share because I'm pretty sure shares an issue for DGL have increased maybe significantly. We can see that. Here we go. Shares on issue have increased fourfold, maybe, from 60 million to 283 million. I don't know about that. Seems a fair bit. And that's, yeah, that's also, if that has happened, that also explains, even though the revenue looks really impressive, maybe the revenue per share has actually dropped. And also, probably the other problem with DGL has been the margins. I'm assuming the margins have dropped a fair bit. So the gross margins. Let's have a look. Where is it? We have to go to margins, gross margins. Oh, according to this, gross margins have risen. Not sure about that. Now, I have not had a look at DGL's financial year 24 numbers. Now, that rise in gross margins is interesting. So this is going to be interesting when I have a look at DGL. Anyway, so if I did see revenue falling over a 3-year period, that would be a red flag, particularly if it's well, if it's just revenue, and if they've been increasing the shares and revenue's been dropping, that's an absolutely massive red flag. So let's have a look at the chart for DGL. So again, I'll just get rid of these because this company is hated on the ASX right now. Share price just keeps on going down. But at some point, there will be value. Now, the thing I'd be waiting for here is any sign of positive news from the company. Now, there's a possibility they never release positive news again, but that's one thing I'll be waiting for here. The other thing I'd be waiting for is the share price isn't downtrend, just keeps on dropping, just gradual drop. That has to come to an end, in my opinion, for me to get excited about DGL Group. Just keeps on dropping. And the company has, the last time released really bad news was on the 27th of February. So we are 6 months removed from that. So hopefully the company can release something positive sooner rather than later. Anyway, but you're absolutely right. If I do see revenue dropping, particularly if it's revenue while shares and issue have been increasing, that is a massive red flag for me. I prefer to see revenue increasing through time. But the other thing you have to take into consideration is cyclicality. Cyclicality. Is there any reasons it's been dropping? And if it has been dropping and it's the bottom of the cycle, then it's going to be upswinging soon. Mining companies, very important when it comes to mining companies. Okay, that's all I got for today's video. Hope I've answered your questions to your satisfaction. If I have not, and sorry, David Reece, you were the next question, but yes, and then Ben Hutchinson. If you do have questions, any thoughts, leave them in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.